Every bad real estate deal started out looking like a good one. Today, we're going to share the 7 red flags to watch for in potential real estate deals. We currently have over 500 rental units, and we've seen the good, the bad, and the ugly. And today, we're going to share what we've learned through the years. At Faris Capital Partners, we've built a process to spot red flags early so that we don't waste our time and risk our investors' capital. John, it's great to be here with you.
Good to be here, Mark. Processes and systems, right? I think that's where businesses succeed or fail. Really the lack of processes and systems is how they fail, in my opinion. And I remember when we initially sat down, we started talking about what are our non-negotiables, what are our golden rules. Obviously, we covered things like our mission, our values, our vision, et cetera. But those golden rules have really helped us avoid some of the maybe potential bad deals that are out there in this market now. It's interesting. Like, is there really a bad deal, or is there just, is it structured poorly? Or are there bad assumptions, right? So those are some things we can discuss on another podcast. But by having those golden rules and those non-negotiables, it just really blocks out a lot of the noise, I guess, for lack of a better way of saying it. We can really just focus in on those deals that meet our criteria. So excited for today's podcast and to dive in a
Mm-hmm.
little bit more on this topic.
Well, John, because we've looked at, I mean, just to date, so we just got a 66 unit deal under contract, and we had to go through 300 deals. So, just to kind of start off, one of the best ways to spot red flags is to do a high volume of deal review on an ongoing basis. If
Yeah.
you're doing like one deal a year and you're going in and you're trying to assess it, there's no way that an individual, if you're doing one deal a year compared to like 300 within the first few months of the year, that we've actually gone through and we've analyzed. And so when you have that kind of deal flow coming through, it just allows you to get better at it. So I would just start off by saying that if you can increase the amount of deal flow, increase the number of deals that you analyze on an ongoing basis, it just common sense that you're going to get better at that. So I'll just kind of preface the conversation with that, because I think that in general, the average investor, they see a deal, and it's not slighting them, because I know a lot of, or you're working full-time job and it's busy and you love real estate and whatnot. But if you are not analyzing deals on an ongoing basis, then the suggestion here is to be extra paranoid of the red flags that can come up. And that's why listening to podcasts like this is good. Okay, I'm going to watch for that. And then you start to create your own little checklist so that when you go in on the deal, you can start to identify these red flags. But just by increasing your deal flow, you'll be able to start analyzing and spotting the red flags a lot sooner.
That's right. It's interesting, Mark. At my prior company, Mark Spain Real Estate, we're big on acronyms and kind of internal language. It's a great way to build culture. And one of the things it was actually our director of training came up with. She called it reps. It was real estate professionals practicing scripts. So that's what we called our script practice. And kind of like when we would do role playing and things like that. And so you're dead on, right? It's that ability to like just build muscle, right, through doing reps. And in this business, that's underwriting deals. And so, we have a great piece of software that we can input financials into it. It normalizes us and it helps us kind of see pretty quickly whether it's something we should pursue or not. We have to do a little more steps beyond that, but it gives you a great kind of first like pass, like, is this something we should review further? But the point is we kind of put every deal in there. Now, if it's just completely outside of our buy box, if it's like a opportunistic, or if it's like a built in 2024, build to rent, single family rental community, we're not going to spend any time on that because it's not what we do. We buy apartment buildings, not single family rentals. And we just sometimes get those deals. But if it's an apartment building and it's kind of in the general buy box, we're going to take those steps. But it's because what you outlined, it's just seeing what's in the market. It's understanding the deal flow. We track those deals. Did it close? What did it trade for? So we do put a lot of reps in on deals that we really don't have an intention of buying, but it's just keeping us sharp and it's allowing us to see what's happening in our markets. At the very minimum, we're learning about potential future competition, right? So I think you're dead on. You can't just decide to invest in real estate and go underwrite a deal and buy it. You should be looking at a lot of properties on a daily basis, getting those reps in, building that muscle, so to speak. So it'll help you make those better decisions and then spot those clear winners, right? Because when you have nothing to compare it against, everything might look like a winner,
Yeah.
but then you see 10
Yeah.
other deals, you're like, whoa, actually, this one's kind of a stinker. Like these other ones are much better, right?
Yeah.
So I love that concept. It's about putting those reps in.
100%. And that aligns with our making wise choices core value for us. And so by analyzing these red flags and identifying them early, it saves you time, saves you money, and ultimately it saves your reputation as well. Because, so John, for example, I was sitting beside this. I recently joined YPO, which is an organization for young professionals, and so I'm sitting at this dinner, and I have uh, a member that's sitting on the left of me. So Joanna came with me as well, so we're all with our spouses. But there was a member to my left, and he had exited his business for 500 million. And then on my right, he currently oversees a portfolio of 500 billion is what
Mm,
he has. Like like it's massive.
yes.
And he's like, I was starting to talk to him a little bit, and he's like, he remembered, he was reminiscing of his very first fund that he did, where he's like, I had to beg, borrow, and not steal, but he had to beg and borrow
Yeah.
uh, for his first fund of like $30 million. And he's like, Mark, he's like, there's nothing that comes close to this. And he went on to say that the number one thing in any sort of private equity group, real estate investment fund, because I told him, what we're doing as well. And he's like, the number one thing is your track record.
Mm,
He's like, there's nothing that comes close to that, your track record.
yeah.
And so when you go into these deals, a red flag can mean potentially your reputation at the end of
Yeah.
the day, which can blow up your entire, your entire business. And so that's where for us, like we are hardcore on identifying the red flags and to build to vet them out, not just, oh, it's going to work itself out. No, 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 no. Every single potential red flag, like we need to go down that rabbit hole and check that box off to make sure that we got it. Because coming back to our investors after and say, oh, sorry, we missed this, like that's not acceptable in a professional company.
That's
And
right.
that's the power. And that's why, John, I was so hardcore with building a team of hardcore individuals that have expertise. And so when we surround ourselves and we are vetting a deal out, and we're jamming on it in regards to, debating, what about this, what about that, and we're making final decisions. We have a voice from asset management, we have a voice from finance and acquisition, and then market, and then the overall big picture and the equity side, how that works for structure and all the rest of it. And so these are big decisions.
Yeah.
And so the red flags we're going to go over with you today, they're going to really help you make wise decisions moving forward, whether it's a single family property, you're just looking to buy an extra investment property, or you're looking to get into a syndication type group like with Faris Capital Partners here.
Yeah, that story you just shared, that wisdom from that gentleman you met there at that event, puts me in the mind of Warren Buffett. And he said, it takes 37 years to build a reputation. It takes 37 seconds to destroy it, right? And so, just being very mindful of these red flags and ensuring that, the deals are stress tested and we're interrogating everything is very important to who we are. And it's really right there in our values, our vision, and our mission. So, one of the first red flags, Mark, that comes up, and it's amazing how often we see this actually, but what I would say is incomplete or delayed financials from the seller. And so where we generally see this is with the more mom and pop owners and operators, under 100 units, you'll still run into what I would call the mom and pop operators. And we had a deal recently we were looking at, and we're still actually looking at it. But we say the T12, right? So that's your 12-month financials, right? So you're trending 12-month financials, and that's what we want to see. But they send over a T3, and so just 3 months. And so you can gain some information from that. But what I start to think about is, okay, what are they not wanting to show us that happened 9 months ago? Are there sloppy operations or things being hidden potentially? Bottom line, we're just not getting the full picture. 3 months of a building's operation is not enough to build a full picture. So we want to see at minimum that T12. So, there's that. But even within a T12, right? Maybe the numbers just look a little too clean or, kind of conveniently rounded up, right? Where, the cost of utilities isn't, a round number. It's going to be like $372.68. So when you see stuff like that, you got to have an eagle eye and, I don't think we've ever seen any outright fraud or misrepresentation yet. All the deals we're doing are being marketed, whether off market or on market, through highly reputable national brokerages, right? We do work with some boutique brokerages, but their reputation's on the line. So they're often doing the same review and spotting these things. But, we talked about this a little bit on our last podcast. It's okay to have a healthy amount of paranoia, particularly when you're making big decisions on somebody else's financials. So, really going through those financials with a fine tooth comb, ensuring you have a full T12. And if you see something that looks wrong, ask a lot of questions and don't be afraid to ask for bank statements and, matching up the rent roll with the financials, because we also get the rent roll, which is just an accounting of every single lease that's currently in place from when they sign the lease, when their expiration is, their rental history, whether they're on time, lease violations, and all that. And so, ensuring that the rent roll matches the T12, right? These are just little steps you have to take. But if you miss these steps, could really create a significant issue. Then, when we're touring the asset mark, this was something we learned very early on. And we have a construction manager on team who comes to the property. So he really helps us with this. But when you do a broker tour, they normally open up a couple of units, show you the amenities in the leasing center. And so it was interesting, Mark. I was recently at a deal that we put a letter of intent out on, and I'm hopeful we'll win it. I think we will. But they had the tour stacked. And so, all that to say, I was still on site walking around, looking at compressors, looking behind every building, walking around, and I saw a tour come and go, within 20 minutes. And it's just, I don't know the operator. Maybe they had a second tour. Maybe this was their second and they just were confirming some facts, but just caught it so interesting to me that they can in 20 minutes make a decision on this. I was down there for 2 hours, taking, I think I took 179 photos and 10 5-minute long videos just to kind of have everything that we could go through when we're doing our underwriting. Go, ooh, wait a minute. Did you notice all this wiring here? We're going to have to deal with that. Let's add that to the budget. Or did you see how this dumpster enclosure looks really crappy? We need to fix that or finish that or relocate the dumpster. So having a very, very tight due diligence unit walk process. This is before we actually go under contract, by the way. So we're walking as many units as possible, walking the full property. And then you have to then go back to the financials and make sure everything's matching up, with the reality of what you just saw. So I would say, making sure that you're really studying those financials and ensuring you have perfect, clean, good financials.
Yeah, no, it's easy for we'll say, the existing owner to maybe hide things or kind of like, we'll say, not intentionally, like, I'm gonna fudge the numbers, but they might just be an error or it
Yeah,
might just be a mistake. And
correct.
so that's where, the good news is if you do a really good job on the underwriting, on identifying the trailing 12 months, and then you have your P&L, you have your rent roll as well. If you do a really good job at analyzing, you can actually find opportunities that can be in your favor as well.
That's
And
true.
so that's like, it's like, oh, bonus. And so some groups may not be able to find that. And if you're able to find an opportunity or an opportunity on how you can maybe you can get maybe they don't have any sort of income coming in on Wi-Fi, or they didn't negotiate a discount based on volume, and maybe their operations is really high. Maybe they have we'll say, a daughter that is a property manager where they're paying the daughter $200,000 to manage their property. If you can go in and start identifying it, and then you can normalize those rents and normalize those numbers and say, hey, listen, when we take over, this is what it's going to look like for us. That's a instant increase in value that you can reflect. And sometimes you can pay a little more than somebody else because you were able to identify other income or save on expenses that the existing owner just didn't know about, or maybe they didn't take advantage of as well. And so that's where that is, it's a potential red flag if they're not done, but it can actually turn around. If you do a good job analyzing it, it can potentially work out in your favor if you're looking at a deep level.
That's right. Red flag number two, deferred maintenance that's not fully disclosed. So that walk I just described is exactly what we're trying to identify. There are situations we've seen where the seller doesn't even know what the age of the property is. And we've seen it where the tax records say one thing, another county document says another. And so you'd be shocked, right? Sometimes what the sellers don't know about the property. Sometimes these operators live in other states and just don't visit as often as you might expect. So even though we're acquiring assets in other states, our asset manager is visiting those sites regularly, typically on a bi-monthly basis. You and I are traveling to these properties quarterly. Sometimes we do surprise drop-ins, but prior to buying, that construction manager I mentioned is doing that full walk. And we were just at a property recently and there's literally like, plant life growing out of the gutters and the gutters are bent and deformed. And, another great example, we were at another deal and they said the roofs were in good condition, but you walk out and you see that they've been patched and, the shingles don't really match and it just kind of looks bad. And so, factoring that into our underwriting and then doing our due diligence, having a full roof inspection, something we do on every property, but, making sure that we're saying, hey, roofing company, like, really put a close eye on this because we have some concerns here. But looking for things like wood rot, walking the property after it's rained, if possible, to see if there's standing water or issues with drainage that you may need to address. Sometimes the sellers will say it's simply cosmetic, but it could be a functional problem. So, doing a lot of due diligence, even bringing in a contractor if necessary prior to submitting your LOI and spending a little bit of money. Better to spend a few $1,000s on a contractor coming in and doing an inspection and not doing the deal than doing the deal with incomplete information. Bringing those contractors in earlier, having a contingency budget in place. And I say this with love because our broker partners, I mean, we work with incredible brokers. If you get to this level in the game where you're selling 50 plus unit buildings, you didn't do it because you were bad at your job. Like these guys are sharp, they're on it. But at the end of the day, they work for the seller and they're trying to sell a listing, right? So don't trust the listing, trust the actual unit walks, right? Trust the property walk and what you see. It's all visible, right? I mean, that's the beauty of the assets we're buying. I mean, yeah, we can't get behind the walls, but you can pull a panel off the electrical system to make sure that it's good wiring. You can do a lot of things to ensure. And part of our letter of intent is for the sellers to provide all inspections, surveys, everything they've received during their ownership, and we put that right in the LOI. So we have all that in hand at due diligence, and then we're conducting those exact same assessments with our own third parties and matching everything up. At the end of the day, we just don't want any surprises. Everything is fixable, but sometimes a surprise isn't because if you didn't budget for it, it could kill your returns. So, red flag number two, deferred maintenance. You have to spend a lot of time at the property and really do a thorough walk, not just a cursory once over.
Well, John, to add to that as well, the broker in one deal we had, it was like, oh, there's just one wall there where the
Oh
retaining
yeah,
wall is looking to, it's a little shaky. And I think he said maybe it's like a 40 feet run. Well, we ended up you were talking to the broker at this time, and then we kind of divided and conquer, so to speak.
yeah,
So you're finding out more about the information. Dom and I, our GC, we ended up doing like kind of a full walk around as kind of like a final because we had walked pretty much the whole property was just the surrounding property. We ended up walking and started going thorough, and we followed that retaining wall along, and we there was vines growing over it, so you couldn't like this was we're talking about 6 foot tall retaining wall. So this is a massive amount of earth that it's holding back, and they were all wood beams. And
mm,
so it looked fine, but then when we stuck our, it was like the secret garden, John. We
yeah,
stuck our
yeah,
hand through the vine, and then we started touching the wood rock, the wooden beams, and our finger went right through it.
yeah.
I'm
Punch
like,
right through.
John, this was 800 feet of run.
Yeah,
Of
yeah.
like this was a huge amount right across the property, and we're like, geez, like we started doing the numbers, and we're looking at like it was about 400 grand is
It's
what it was
almost like a
going to
half
be.
million dollars,
Yeah,
right? I
no,
mean, yeah,
and it was like, whoa, wait a sec, that's an easy thing to miss, and
that's
so
right.
we make sure to do all of our inspections, but we want to catch things before submitting our offer to make sure that we factor in everything. Because the last thing we want to do is go back and do a retrade and it's like, oh, we didn't know about this. Like, you should have known about it, or you should have factored in. And so that's where
Yeah,
with these deals, when we go in with the brokers, we factor in anything that can come up. We factor up. Now, we know that there might be the odd thing, but we have extra buffer in there. And so whenever we go in and we take a property over, generally what's happening is we're peeling back that extra reserves that we have and the deal just gets better. I'd rather do that and be more conservative with the offer than like, oh, we're going to push a little bit and we're not going to include that. And all of a sudden you got an oopsie
Yeah. Yeah.
that comes up down the pipe. Oh, we got 400,000 retaining walls that we didn't catch. Now we got to go back and do a massive retrade, and then that affects the potential future deal flow
That's
with your
right.
brokers. That's like, that just won't happen with us.
That's exactly right. And the broker didn't know either, right? He was going off what the
Yeah.
seller had shared. And, if you spend any time in southern United States, kudzu grows like insane. In fact, I mean it's kind of a pest of a vine. Very tough to manage. And it just grown over everything. And so when the seller said, "Oh, we've replaced every bit but this little bit," broker took them at their word. But you guys literally
Yeah.
pulled,
Yeah.
the vines back, stuck your hand through, and realized that we had a much bigger issue there. So to that point, even though, we didn't necessarily do anything wrong, had we missed that, we'd still be in a position where we're potentially retrading and creating, a damage to our reputation with that particular brokerage and that particular brokerage. Um, Number three, overly aggressive projections. Now, that applies on our side when we're underwriting, but what we're talking about here is like when you get a deal and you're looking at a deal, right? And so not just blindly trusting what you're being told from the broker or the seller or even what you're seeing in the listing service, doing a lot of deep research beyond the surface level. So maybe the broker's offering memorandum shows aggressive rent growth, and one thing we have seen is that submarkets can sometimes butt up against each other but have massively different results just 2 or 3 blocks down the road, right? So we
Mhm.
were looking at a deal in a little market in Atlanta, and I didn't actually like the deal the first second I saw it just because I know that area. It's a very industrial area. It's not like necessarily unsafe. It's just got some aesthetic challenges. There's not a lot of like retail or groceries. There is some multi there. But we went and looked at it. And I'm like, okay, maybe there's a story to tell here. And I went back to the OM and I saw they were pulling stuff from a few miles away. Now, if you drew a radius around it, you might say, well, that's reasonable, but it's a different submarket and there's conveniences right across the street. There's walking trails and there's all these different things. And so when we really narrowed into just that particular submarket, the rent growth simply wasn't there. So once again, I don't think the broker was trying to pull the wool over anybody's eyes, but just knowing the submarkets and knowing what's possible is really important. Or maybe your expenses look suspiciously low that they're projecting in here. So one of the things we do at Ferris Capital, Mark, as you know, is we actually couple of things. A lot of the brokers will actually get new quotes from a preferred property management company where they'll come in and say, "Hey, we've looked at the T12. This is what we could deliver it at." And then we have our property management company, our preferred company, do the same exercise. And then we're leveraging our knowledge of the team, our asset manager and our acquisition specialist and our finance person to go through it as well. So making sure, like I mentioned before on other podcasts, expenses generally aren't going to go down in today's world. So we should be factoring in increases on an annual basis. Or maybe they're showing like no bad debt. In other words, nobody's behind on their rent. You can have the best screening process on planet Earth, but inevitably someone's going to lose their job in the middle of their lease and get behind on their rent, even with perfect credit, perfect rental history. So if you see no bad debt or like very low to no vacancy, that's a red flag. If I see 100% occupancy, Mark, I'm usually going, okay, they must be giving out concessions or they're not pushing rents aggressively. It can mean a couple of different things, and it could be a positive thing. Once again, maybe they're not pushing rents aggressively enough. But these are the things you need to be dialing into. We always say the brokers are trying to sell the dream, like we're trying to buy reality, right? So we're not going to be chasing numbers around that don't make sense. We underwrite with conservative assumptions. We use real comps in the sub market, and we do our own model. We don't rely on any model or information from a third party.
Yeah, right on. Next red flag, we're looking at bad location signals. So this is a big one, and it's very clear when you're starting to drive into an area and you start to see, we'll call it pawn shops, alcohol, liquor stores around the corner, like dollar
Gun
stores,
shops. Yeah.
right?
Yeah.
And so that basically tells you a pretty good idea what is in the general area. And so if when you drive, and you can do this just on Google, I mean, we always recommend doing making sure you're driving the property as well. to have a good understanding. But if you just go down on Google Maps and you do kind of a like immediately around the surrounding area of the subject property, that tells you a lot in regards to the area. And so you got to realize that if that's surrounding the area, that residents don't want to be in an area that is maybe frowned upon with their friends or their family, or that doesn't feel like safety. And so this is a really, really important part. To maybe the broker's saying it's a great area, or maybe you look at it and it's like, oh, that looks good at a high level, or the building looks really good. But doing the assessment of the area is really important, and that's why it's critically important that you know not only the cities really well, but the submarkets and the sub neighborhoods as well. Because John, you said it. I mean, one street over, that can be a completely different neighborhood.
Yeah, that's right. It's why we leverage websites like Spot Crime. We go in, we always pull up the address, see what kind of crime's going on in the area. I don't care if you live in, Bel Air, Beverly Hills, or wherever, there it will be crime, right? So if we see things like, vandalism, or, I hate to say it, but a lot of times, the assault you might see, it's in a community, it's probably domestic violence. Not that that's a good thing, but it just, you see that typical stuff anywhere. In fact, I pulled up my own address and was kind of like, oh, geez, because you see some of that stuff. But it's a very safe area, excellent schools, one of the best neighborhoods in the Atlanta area. So we look at that and we make sure it's nothing with gunplay, drugs, anything like that that would be a deterrent to our building or to our area. We're looking at schools. There's some great resources out there, greatschools.net. There's another one that just escaped me that we'll put in the show notes, but you can get those school ratings and rankings, test scores, etc. And so we're looking at that. So we want to see at least average to above average for the state, if we're going to invest in a particular market. Another thing, one of the other red flags too, Mark, is, kind of like I would say the tenant profile. And by that, what I really mean is like high delinquency. So when you're looking at that rent roll, if, for example, you see a lot of the residents are on month-to-month leases, that's a red flag for us. It could be poor management. It could be something we could fix, but that could actually create an environment where we see an uptick in vacancy. Because if we try to push everybody into 12-month leases and they've been getting month-to-month, they say, you know what, forget it. I'm going to go somewhere else. You might see skipped payments, evictions, special lease exceptions, or leasing violations, which all tell me that residents aren't being screened properly on the front end. And in Canada and the US, when you buy a piece of property and there's a lease in place, that lease supersedes. So I can't just go throw you out on day one. Like, you have to have a leasing violation or eviction or something. And so I don't want to buy somebody else's problem, right? So in other words, we don't want to buy a deal and then have to go through the process of evicting 15 residents and chasing down behind payments. Now, that said, usually there's a little bit of that, but one or two or three we can work through. But if it's a large percentage, we're going to walk away, because ultimately that's telling a story about that particular resident profile and the area in and of itself. So it kind of goes back to the bad location signals. It's kind of clues that you need to be paying attention to. So during our due diligence, once we go under contract, we work alongside our property management company. We walk every single unit, but we also audit every single lease. We look at employment history, rental history, and we get a sense of how the current operator is managing the property and that screening process. By the time we get to that step, we've already done enough research, through the rent roll and the financials, that we're pretty comfortable with where we're at. But what we start to do is identify residents that maybe be a bad fit for our community once we take it over. Excessive lease violations. So, for example, if somebody's blasting, loud music at 3 a.m. constantly, that's somebody we're going to invite not to renew with us, invite to find another community. So, the resident profile goes along with that bad location signals. The next one, this is sort of interesting, Mark, but, when you get a lot of pressure from the seller or the broker, that's kind of a red flag for us. We are all about speed of execution, and we don't waste a minute. We don't wait for tomorrow what can be done today. But when you start getting that pressure of like, we need your LOI by tomorrow, or, other buyers are circling, like, that's normal, right? Don't allow it to impact your decision making at the end of the day. You either like the deal the way you've underwritten, or you don't, right? And so, just don't let that pressure, you know, um, cause you to make a bad decision. So where it makes sense, slow things down a little bit, ask more questions. And if the pressure is unreasonable, walk away, because there's something there, right? And so It's hard to do sometimes when you fall in love with a deal, but listen to your gut, I guess is how I would sum it up. When you feel that gut instinct, that's your subconscious recognizing a pattern you've seen in the past. And you should at least listen to it, even if you still decide to move forward, ask those questions, slow it down just a little bit. 24-hour rule, my dad used to tell me, whenever you feel like you're in an emotional state, wait at least 24 hours before making a decision, right? So that pressure is real. Sometimes you feel it. So don't allow it to cloud your decision making judgment.
Yeah, I think that is wise counsel 100%. There's always going to be another deal. And, I look back through all the acquisitions that I had, it's like, yeah, there were deals that I missed, but going into a deal, I was like, maybe I shouldn't have taken that. It's always better to let a deal slide, especially if it's not like a slam dunk. Every
Yeah.
property that was like, okay, this is a slam dunk. I've done my due diligence. I'm like, I know this is a good deal. I've done well in. But the ones where I was kind of like, I think this is a good one, and those are more rare
Yeah.
through all the different acquisitions that I did over the last 20 years. Uh, those are the ones where I'm like, okay, so moving forward, it's becomes very clear, especially with these larger assets, John. You can't just go in and buy it and then there was a mistake there and I sell it and everything's going to be okay. It's like we're talking about millions of dollars at risk here, and so
That's right.
uh, that's really good counsel. Is like if you're not sure, slow down and just like what, I'll bow it on this one, no
That's right.
problem. And
That's
there's going
right.
to be another deal coming down the pipe. And the key there, John, before we move on, the key there is that you learn from that. You don't just
Yeah.
move on. Like you find out what happened in that deal and was that a good decision or not, and take that key lesson and stack on that for your next opportunity that comes up.
That's it. That's right. No, absolutely. And as you said, there'll always be another deal. But we have it. It's funny. We all talk as a team, and it's just how we're all wired. Like, I couldn't sleep at night knowing that there was something we could have done differently that would have protected our investors and our partners, right? And so it's not to say we're perfect, but at the end of the day, like, there are some operators out there that somewhat laissez-faire attitude about these deals, and because we see them every day when we're touring them. I mean, I just mentioned one we're looking at where there's literal plants growing out of the gutters, and I mean, it's just, to me, it's just like, how many people who worked and owned this property and were vendors, maintenance people, walk by that on a daily basis for months and months and months? It didn't happen overnight, right? And it's just that lack of detail and that lack of execution. So, yeah, it's good counsel all around. I would say the last one, number 7, is if you have to take on high risk debt or a high risk structure to make the deal work, that's a walk away, right? So if it only works with floating rate or bridge debt, or interest only, and for example, for our listeners here, often with Fannie and Freddie Mac, you can get a couple years of interest only payments. So don't get used to those interest only payments. Know that principal is going to kick in, in year 3 or year 4, depending on how it's structured. And so that needs to be in your model. And then your reserves need to be based on that higher amount with the principal, not just the interest only payment. So you just don't want to have, market volatility or rate changes impact your investment, because you have zero control over that. And we're seeing it right now in the US. Donald Trump is putting pressure on the Fed to lower rates, but the Fed's saying we don't see the economic signals to do that yet. And so who knows, right? And so it could be next month, it could be 6 months from now. So we want to make sure the deal works today with the terms that are agreeable today, with fixed rate debt. And if the deal doesn't work, we simply don't buy it. It shouldn't be a thin deal. Like, it shouldn't be razor thin. You should have some comfortable
Mm,
margin baked into it. And it's all about those fundamentals, right? We've talked about those ad nauseum on this podcast, but it's that cash flow on day one, 6 months reserves, fixed rate debt. If it
mm,
doesn't work with those 3 things, we simply don't do it.
yeah.
So we don't chase deals that only work on paper with a lot of creative mathematics. I'll just put it that way.
Yeah, and the only way we get there, John, is by doing a massive amount of deal flow. And so
Yeah.
it's like I don't see any deals coming through. It's like we don't see any deals either on a day-to-day basis, but we do it enough where eventually we get a good one.
Yeah.
And so that's where you got to increase your deal flow, which means you got to increase your conversations with brokers. It means potentially you need to go into new markets as well, which means that you need to spend more time doing the research. And so they're out there. It's just you got to have a system for analyzing and finding these deals, because this is the last thought and we're going to wrap it up. That red flags, they don't go away with time, they grow.
Yeah.
Red flags don't go away with time. They grow. And the best time to catch the red flag is before you get into the deal. So that's where if you can become an expert, and I hope that you're able to take a few red flags from this conversation, write them down, and moving forward, you catch them before you get in, because when you get into the deal and there's a red flag that comes to life right in front of you, it becomes a lot worse, and it gets worse and worse as time goes on in general. So
Right.
spot the red flags, get ahead of it, and potentially say next and move on to the next deal, because there's going to be another deal coming down the pipe.
That's right.
Uh, and anything else, John, on your end before we wrap
No,
up?
I
Yeah,
just I would say, if you're intrigued by what you've heard today and you'd like to learn more, go to fulloutinvesting.com. We have a wonderful video on there that explains not only more about apartment syndication investing, but more specifically how we do it and how we approach it. There's also a sample deal on there. So if you're an accredited investor, somebody who's making over 200,000 in income on an annual basis, or 300 with their spouse, or you have $1 million in investable assets that does not include your primary residence, you can go on that site, fill out the form, book in a time. We'd be happy to talk through what we've got going on right now. We have deals launching soon. So that's a great resource for you, fulloutinvesting.com.
right on. Well, thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.